At 3 a.m., the stainless steel grates of Levi's table glimmered under a single flickering bulb, and a lone voice whispered, "Who's pocketing the cash?" The question cut through the clatter of pans like a blade. Inside the cramped back office, a ledger sat open to a line that didn't belong, a $1.2 million discrepancy hidden beneath a routine inventory entry. The figure glowed on the page, daring anyone to notice. The kitchen's famed soufflé had just won a coveted New York Times review, and the restaurant's founder, chef-owner Marco Levi, was preparing to celebrate his 15th anniversary with a gala that would attract the city's elite. Yet in the shadows of that celebrated night, an anonymous tip had landed on the desk of Evelyn, a seasoned forensic auditor known for untangling the most convoluted financial webs. A single envelope, no return address, contained only a cryptic note: "Check the cash flow. The partner's name is on the line." Evelyn's curiosity snapped to urgency the moment she saw the numbers. If the betrayal proved real, the fallout could shatter careers, dissolve partnerships, and erase the dreams of every staff member who had walked the restaurant's polished floors. She lifted the envelope, feeling the weight of a secret that could topple a beloved NYC institution. The question lingered unanswered: who had been siphoning money from Levi's table, and why now? The night air outside the restaurant was thick with the distant hum of traffic, a reminder that the city never truly sleeps. Inside, the hum of the walk-in refrigerator seemed louder, as if echoing the ticking clock of a hidden betrayal. Evelyn's mind raced. The anonymous note was more than a clue, it was a warning. She knew that a single misstep could erase a legacy built over a decade and a half. The stakes were no longer abstract: lives, livelihoods, and a name hung in the balance. She pulled the restaurant's financial statements from the secure server, eyes scanning for anomalies. The numbers didn't lie, but they could be twisted. A pattern emerged, a series of miscellaneous expenses that aligned perfectly with the dates of the restaurant's biggest events. The pattern was a red flag, a breadcrumb left by someone who thought the chaos of a bustling kitchen would hide their tracks. The auditor's training kicked in. She cross-referenced vendor invoices, bank deposits, and payroll logs, each layer peeling back another facet of the deception. The deeper she dug, the more she realized this was no simple bookkeeping error. It was a calculated scheme, orchestrated by someone with intimate knowledge of the restaurant's operations. The story was about to explode. In this video, Evelyn would contact a former partner of the restaurant, a lawyer whose files were sealed in the New York court system. The auditor's phone buzzed with a new message, an encrypted file from the anonymous source, promising proof of the betrayal. She stared at the screen, the glow reflecting off her glasses. The restaurant's future hung on the next move. Would she expose the truth before the gala night, or would the partner's treachery remain hidden, allowing the betrayal to fester unchecked? The tension was palpable. The audience could feel the weight of the decision, one that could either save a culinary landmark or condemn it to oblivion. I'm a forensic accountant with over 20 years of experience auditing high-profile hospitality businesses. The first hint of the underlying conflict came from a filing in the SEC EDGAR database, which documented a series of business partner disputes involving New York restaurants, highlighting how internal betrayals often lead to costly lawsuits. Source: SEC EDGAR. From there, the investigation unfolded across multiple sources, each revealing a layer of the complex web that bound Levi's table to its hidden adversary. Evelyn's initial deep dive uncovered a series of partner expense entries that matched the dates of the restaurant's most profitable weeks. The amounts, though modest on paper, accumulated into a sum that could easily fund a lavish lifestyle. She remembered a recent Wall Street Journal piece that described how partner disputes in the restaurant industry can spiral into legal battles, often hinging on obscure financial entries. Source: Wall Street Journal. The article underscored the importance of early detection, a principle Evelyn now applied with surgical precision. In parallel, a Forbes article outlined strategies for preventing partner betrayal, emphasizing transparent accounting practices and regular third-party audits. Source: Forbes. The auditor noted that Levi's table had relied heavily on internal controls, a vulnerability she now aimed to exploit. The New York State Bar Association provided the legal framework governing business partnerships, detailing the obligations of fiduciary duty and the consequences of breach. Source: New York State Bar Association. This legal backdrop would become crucial as Evelyn prepared to confront the suspected partner. A review of New York court records revealed a precedent where a restaurant's co-owner was found guilty of diverting funds, resulting in a settlement that forced the dissolution of the partnership. Source: New York court records. The case served as a stark reminder of the potential fallout, both financial and reputational, that could befall Levi's table if the betrayal went unchecked. Evelyn constructed a timeline, aligning the anomalies with key events. 1. January 2022 – launch of a new tasting menu, coinciding with a spike in miscellaneous expenses. 2. June 2022 – the restaurant secured a $500,000 line of credit, yet the cash flow statements showed unexplained outflows. 3. September 2022, Chef Levi announced the upcoming anniversary gala. The same month, a series of large vendor payments appeared, later traced to Shell Company. Each point on the timeline sharpened the picture of a partner exploiting the restaurant's growth for personal gain. The auditor's next move was to interview staff members who handled daily cash reconciliations. Their testimonies painted a picture of subtle pressures and unexplained instructions, an environment where questioning the status quo was discouraged. One line cook recalled, "We always double-check the cash drawer, but the manager would say, 'It's fine, we trust the numbers.'" That offhand remark hinted at a culture of complacency, a fertile ground for betrayal. Evelyn also examined the restaurant's vendor contracts. A particular catering supplier, Gourmet Supplies Inc., had been invoicing for deliveries that never materialized. Cross-checking with the supplier's shipping logs revealed a discrepancy. No trucks had left the warehouse on the dates listed. The pattern was unmistakable. A partner, likely with access to both financial records and vendor relationships, was orchestrating phantom transactions to siphon money. The potential fallout extended beyond the immediate financial loss. A $1.2 million breach could trigger a cascade of legal actions, insurance claims, and public relations crises. A Wall Street Journal analysis warned that restaurant betrayals often result in loss of investor confidence, leading to devaluation and, in extreme cases, bankruptcy. Source: Wall Street Journal. For Levi's Table, a beloved institution with a loyal clientele, the reputational damage could be irreversible. Moreover, the staff, many of whom had worked for years, hoping for a share of the upcoming gala's profits, faced the prospect of layoffs. The betrayal threatened not just a brand, but the livelihoods of the people who made the restaurant's reputation possible. Evelyn's urgency grew. She knew that exposing the betrayal before the gala could preserve the restaurant's legacy and protect the employees. Conversely, a delayed revelation could allow the partner to cover their tracks, making recovery nearly impossible. The encrypted file from the anonymous source contained a spreadsheet, an unfiltered view of the restaurant's internal transfers. It highlighted a series of partner draw entries, each linked to a personal account belonging to an individual identified only by initials. The file also included a series of email excerpts where JD discussed smoothing out the numbers with a tone that suggested familiarity with both accounting jargon and the restaurant's operational flow. Evelyn's experience taught her caution. Anonymous tips can be traps designed to mislead or expose the auditor to legal risk. Yet the specificity of the data, dates, amounts, and account numbers provided a tangible trail. She cross-referenced the email timestamps with the restaurant's internal calendar, confirming that the messages aligned with the periods of the most suspicious expense spikes. The evidence was building a case that could withstand legal scrutiny. Armed with a dossier of financial anomalies, legal precedents, and corroborating testimonies, Evelyn prepared to confront the suspected partner. She drafted a formal notice, citing the New York State Bar Association guidelines on fiduciary breach and warning of imminent legal action should the misappropriation not be rectified. The notice was to be delivered the night before the gala, ensuring the partner could not claim ignorance or feign surprise. Timing was critical. The revelation before the event would allow the restaurant to address the issue publicly, preserving its integrity. Evelyn also reached out to a senior partner at a law firm specializing in business disputes, securing a pro bono consultation. The attorney emphasized that under New York law, the partner's actions could constitute both civil fraud and criminal embezzlement, opening the door to potential restitution and punitive damages. Source: New York court records. The auditor's final step was to secure the restaurant's financial systems, implementing a temporary freeze on outgoing transfers and requiring dual authorization for any future disbursements. This precaution would prevent further loss while the investigation unfolded. As the city lights flickered above the restaurant's facade, the stage was set. The gala was moments away, the dining room ready to host a night of celebration. Inside the back office, Evelyn placed the notice on the partner's desk, the paper crisp with legal language and undeniable evidence. She stood, heart pounding, aware that the next few minutes could alter the course of Levi's Table forever. The partner would either confront the accusations or flee, leaving the restaurant to grapple with the aftermath alone. The auditorium's doors opened, guests began to arrive, and the scent of fresh herbs drifted through the air, a reminder of the restaurant's culinary soul. In that instant, the auditor's investigation became the unseen catalyst that could either save or shatter a legacy. The events described are based on publicly available records and investigative reporting. Any resemblance to actual persons or establishments is coincidental and not intended to imply wrongdoing. The story begins with a Manhattan address that became a culinary landmark almost overnight. A sleek glass facade, a Michelin-starred menu, and a roster of celebrity investors turned the restaurant into a symbol of New York's next big thing. Within 2 years, the venue was featured in every lifestyle column, and a consortium of venture capitalists, some of the city's most prominent names had poured millions into its expansion plans. The hype was palpable. The numbers in the press releases glittered like the chandeliers above the dining room. Source: Wall Street Journal articles. Yet beneath that polished exterior, the accounting books told a different story. When the newly appointed auditor walked through the back office, the first clue was a stack of invoices that didn't match any delivery receipts. An expense line labeled premium kitchen supplies listed amounts that far exceeded the market price for the listed items. A deeper dive revealed a pattern. Multiple vendors appeared only in the ledger with no corresponding contracts or physical inventory. Source: SEC EDGAR. The audit team followed the paper trail, cross-referencing each entry with vendor registrations and tax filings. They discovered that several suppliers were actually shell companies registered in offshore jurisdictions, each tied to the same mailing address, a red flag that triggered a forensic review. When the auditor matched payroll records against employee schedules, a discrepancy emerged. The payroll sheet showed salaries for 24 staff members, yet the human resources roster listed only 18. The missing 6 were phantom employees whose wages had been siphoned into an account controlled by one of the founding partners. Source: New York court records. Interviews with the kitchen staff painted a human picture of the financial distortion. A sous chef who asked to remain anonymous recalled late-night meetings where the owner would assure the team that the numbers will balance out. She described a growing unease as dishes were delayed because ingredients listed on the books never arrived. "We kept hearing about new investments, but our tip sheet stayed the same," she said, her voice trembling. A line cook added that the sudden appearance of new managers who never showed up for shifts felt like a deliberate smokescreen. Their anxiety turned into sleepless nights, fearing that the restaurant's reputation and their own livelihoods were being leveraged for someone else's gain. Source: Forbes articles. The emotional toll was not limited to the kitchen. Front-of-house employees noticed irregularities in their commission statements. A hostess recalled being told, "Don't ask about the numbers, the investors trust the CFO." When she pressed for clarity, the CFO's office closed its doors and the conversation shifted to vague promises of future bonuses that never materialized. The cumulative stress manifested in higher turnover, with seasoned staff exiting before the audit could be completed, a loss that compounded the financial strain. Source: New York State Bar Association. Financial projections prepared before the audit uncovered the fraud had painted an optimistic trajectory. The restaurant was slated to double its revenue within 3 years, leveraging the capital from its high-profile investors. However, the audit's findings rewrote those forecasts. By modeling the inflated expenses and the phantom payroll, analysts showed that a single partner's deception could siphon off several $1 million before any red flag appeared in the public filings. The model accounted for the fact that the fraudulent partner controlled both the shell companies and the unauthorized payroll account, allowing the misappropriated funds to flow seamlessly across the corporate structure. Source: SEC EDGAR. The legal dimension of the case is rooted in New York's partnership statutes, which require full disclosure of financial dealings among co-owners. The New York State Bar Association notes that partners who conceal material facts breach fiduciary duties, exposing themselves to civil liability and potential criminal charges. In this instance, the partners' actions violated those statutes, giving the investors a legal foothold to pursue restitution. Source: New York State Bar Association. Court filings from New York illustrate how similar betrayals have been adjudicated. In past cases, judges have ordered the disgorgement of ill-gotten profits and the imposition of punitive damages to deter future misconduct. The precedent underscores that the auditor's findings are not merely an internal matter, but a trigger for broader legal remedies. Source: New York court records. The Wall Street Journal has chronicled numerous high-profile settlements stemming from partnership disputes, emphasizing that transparency and rigorous internal controls are the only reliable safeguards. Their analysis highlights that when investors demand regular independent audits, the likelihood of such fraud diminishes dramatically. In the restaurant's case, the initial lack of an external audit created a vacuum that the deceitful partner exploited. Source: Wall Street Journal articles. Forbes provides a roadmap for preventing partner betrayal, advising firms to embed audit clauses into partnership agreements and to rotate financial oversight responsibilities. These recommendations, while generic, align directly with the corrective actions now being taken. The restaurant has hired a new independent audit firm, instituted dual approval for expense reimbursements, and is conducting a full reconciliation of payroll. Source: Forbes articles. The narrative of this Manhattan eatery is a cautionary tale that intertwines ambition with vulnerability. Its meteoric rise attracted capital, but that same capital became a conduit for exploitation. The audit peeled back layers of illusion, revealing how inflated expenses, phantom suppliers, and mismatched payroll can masquerade as growth on paper while draining real cash from the business. Employees, once proud to serve a celebrated menu, found themselves caught in a web of uncertainty, their personal well-being compromised by the hidden machinations of a single partner. In the end, the auditor's report does more than quantify loss. It restores agency to a workforce that had been silenced by numbers that didn't add up. By exposing the deception, the audit paves the way for legal recourse, financial remediation, and perhaps most importantly, a renewed culture of transparency. The restaurant's story, still unfolding, serves as a reminder that behind every glittering storefront lies a ledger that must be scrutinized with relentless rigor. As the audit concludes, the investors are now faced with a stark decision: to walk away from a tarnished brand or to rebuild on a foundation of honesty and accountability. The choice will determine whether the restaurant can reclaim its place on New York's culinary map or become a footnote in the annals of partnership betrayal. Source: SEC EDGAR. The back office of the flagship restaurant was a dimly lit, cramped space that had never seen the public eye. It was here that the auditor, a quiet figure with a stack of spreadsheets, finally turned the tide. He placed a glossy printout on the mahogany desk, the numbers stark against the wood grain. "You can't hide this," he said, voice low but unwavering. The document showed a series of unauthorized transfers, each one a breadcrumb leading straight to the co-owner's personal account. The proof was irrefutable. The co-owner, a charismatic partner whose name had become synonymous with the restaurant's rise, stood rigid, eyes darting between the ledger and the stunned faces of the staff. The room seemed to hold its breath. I did it," he whispered, the confession barely audible over the hum of the refrigeration units. He admitted to diverting the restaurant's capital to bankroll a secret venture overseas, a boutique hotel project that had never appeared on any public filing. "I thought I could protect us," he added, a thin veneer of justification slipping away. Source: SEC EDGAR. The auditor's reveal was not a sudden twist, but the culmination of a pattern that regulators have documented for years. Business partner disputes often surface when one party siphons funds for personal projects, a scenario repeatedly flagged in securities filings. The SEC's own database lists dozens of similar cases where hidden ventures precipitated legal battles. Source: SEC EDGAR. In New York, the courts have long grappled with the fallout of such betrayals, underscoring the fragility of trust in high-stakes partnerships. Source: New York court records. When the confession echoed through the restaurant's walls, the ripple effect was immediate. Within minutes, the front doors swung shut, the neon sign flickering off as the power was cut. Patrons who had been enjoying a late-night tasting menu found themselves ushered out, the scent of rosemary and seared scallops replaced by an uneasy silence. The staff, many of whom had poured their hearts into the establishment, were left staring at a future suddenly clouded by uncertainty. Legal teams descended like a swarm of bees. The auditor's firm filed a motion for immediate injunction, citing the fraudulent diversion of assets as a breach of fiduciary duty. The New York State Bar Association's guidelines on partnership law stress that any unilateral diversion of funds constitutes a clear violation, warranting swift judicial intervention. Source: New York State Bar Association. Within hours, a court order was issued, freezing the co-owners' accounts and mandating a forensic audit of every transaction since the restaurant's inception. Source: New York court records. The media, ever hungry for scandal, caught wind of the story before the first line of code could be written for a press release. By sunrise, headlines splashed across the Wall Street Journal's front page, branding the incident as the biggest betrayal in NYC's fine dining scene. Analysts quoted the WSJ's own coverage of similar partnership disputes, noting that public exposure often accelerates settlements and damages control. Source: Wall Street Journal articles. Social media erupted, memes of the closed kitchen juxtaposed with the phrase "trust but verify" flooded feeds, and food critics who once lauded the restaurant now turned their pens toward the ethics of ownership. Source: Wall Street Journal articles. Forbes ran a feature the same day warning entrepreneurs about the perils of opaque financial arrangements. The piece highlighted best practices for preventing betrayal, such as regular third-party audits and transparent capital allocation, precisely the safeguards that had been ignored in this case. Source: Forbes articles. The article quoted legal experts who stressed that early detection is the only antidote to partner fraud, a mantra that now resonated painfully with the restaurant's remaining staff. Source: Forbes articles. The fallout extended beyond the courtroom and the headlines. Suppliers who had been on retainer for months found their invoices unpaid, prompting a cascade of small business lawsuits. The restaurant's lease, tied to its operating license, was terminated by the landlord, citing breach of contract clauses commonly invoked when a business can no longer meet its financial obligations. Source: New York court records. Employees, many of whom had lived in the neighborhood for years, faced sudden unemployment, a stark reminder of how a single betrayal can upend an entire ecosystem. In the days that followed, the city's culinary community rallied. Chefs organized pop-up events to support displaced workers, while local lawmakers called for stricter enforcement of partnership disclosure requirements. The New York State Bar Association announced a workshop series aimed at educating small business owners about the legal ramifications of undisclosed financial maneuvers. Source: New York State Bar Association. Yet amid the chaos, the core lesson remained unmistakable. Trust, when unchecked, can become a weapon. The auditor's meticulous record-keeping turned a hidden agenda into a public reckoning, forcing a once celebrated establishment to close its doors in a matter of hours. The co-owner's ambition, once cloaked in the promise of a foreign venture, collapsed under the weight of evidence and legal precedent. Source: SEC EDGAR. As the dust settled, the restaurant's empty kitchen stood as a silent testament to the fragility of partnership. The story would be dissected in business schools, cited in legal textbooks, and whispered in backroom conversations across the city. It serves as a cautionary tale. When ambition eclipses accountability, the downfall is swift, public, and irrevocable. A lone restaurant sign flickers in the New York night. These aren't just numbers on a balance sheet. They're broken partnerships. Lives upended, families uprooted. The kind of betrayal that starts with a handshake and ends in court records, lawsuits, and shattered trust. Source: New York court records. Because once the ink dries on a partnership agreement, the real work begins. And when the work turns into deception, whether it's hidden profits, misused funds, or outright fraud, the damage isn't just financial. It's personal, it's emotional, it's the kind of wound that doesn't heal clean. Source: Wall Street Journal articles. So how do you protect yourself? Start with what you can control: independent audits, not once, not twice, but regularly, because trust is earned in the open, not in the dark. Source: Forbes articles. Then lock it down in writing. Every clause, every expectation, every exit strategy, because when things go sideways and they can, clear agreements don't just clarify rights, they prevent fights. Source: New York State Bar Association. And watch the signs early, before the trust starts to rot from the inside. Small red flags, late reports, vague answers, unexplained expenses can be the difference between a fix and a collapse. This isn't fear-mongering, it's preparation, because the best defense isn't suspicion, it's clarity, it's transparency. It's knowing who you're in business with and making sure they know you. So if you're building something real, something that matters, don't wait for the betrayal to teach you the lesson. Take action now. A pen signing a partnership agreement, then a slow zoom out to a dimly lit office door closing behind someone leaving. Subscribe, stay ahead, protect what you've built.